Now students, I'm going to discuss about a very important statement, basically a report which is prepared by the companies, and that's called cash flow statement. As its name suggests, that it is all about the cash oriented activities of the company. They are reflected while making the statement which we call as cash flow statements. So technically, we usually pay stress on the profit because when it comes to sole proprietors, when they are running their sole proprietorship business, or if we talk about the partnership, it is the statement of profit and loss and statement of financial position which we make. So, statement of profit and loss is normally made by all types of businesses, but when it comes to companies, it is not just the profit on which we'll have to have a stress on, but we will also be considering the cash position of the company as well. Though I wouldn't say that the profit calculation is not important, but considering that though the profit calculation is very important as far as all types of businesses are concerned, but when it comes to companies, they will also be considering the cash situation of the company as well. But what is the difference in between profit and the cash? Are they not the same thing? And the answer is no. As when it comes to profit, it basically follows accrual approach. By accruals, I mean to say that whensoever for a certain specific accounting period we are calculating our trading profit, we need to see that how much of the expense has been incurred. We do not see that whether the expense is being paid right now in the current period. By being paid, I mean to say that if the cash is gonna be spent in the current period, or if the expense has been incurred but the cash will be spent in the next period. And there could also be a chance that expense relates to the period, expense has been incurred in the current period, but its cash has already been paid in the previous period. So when it comes to profit, we do not consider the cash situation, has it been paid or not. We just need to see that how much of the expense is relevant to the period, whether it's been paid or. That is what the accruals approach is. So for a certain period, we need to see that how much of the expense has been incurred and how much income has been earned. Again, as what we see that income can be generated either on cash basis or accrual basis. So there can be a chance that we have sold something and we have received the cash instantly, and there can be a chance that we have transferred a good for which the cash is yet to be received, or maybe it has already been received in the past. But ignoring when the cash is going to be received or has it been received or not, we just need to see that if the income is gonna be relevant to the current period, again by applying the accruals concept, the matching concept, we just need to see that a period for which we are actually preparing our profit and loss account, in that period we just do not consider that how much of the cash has either been spent or how much of the cash has been received. All we need to see is that how much of the expense is relevant to the period, how much of the expense has been incurred with respect to the current period, and how much of the income is relevant to the current period. How much of the income has been generated in the period, again by just ignoring whether the cash has been received or not. So for instance, if in a certain period we have generated a revenue of $5,000 for which the expense figure is of $2,000, that shows that company has been able to generate a profit of $3,000, and we haven't taken this thing into account that is the cash equivalent to $3,000 available to us or not, because there could have been a chance that we have sold a lot of items but everything has been sold on credit, so we might not be having any cash right now, but still it generates that if I just match income and the expenses with respect to the current period, it is generating a profit of $3,000. But when it comes to the fact that how much of the cash the company has generated in a certain period, for which purpose, as what I've told you, that we have to prepare the statement which is called statement of cash flows, which I'm going to discuss with you people shortly in detail. It actually indicates that for a certain period, how much of the cash has been received and how much of the cash has been paid. I mean, all the inflows as well as all the outflows are to be taken into account in order to see that what is the net situation as far as the cash is concerned. Do we have a positive cash with us, or we are in a position in which we may say that our company is like having a cash deficit? So it is like all about that how much of the cash has been received. Maybe it is like relevant to any activity, any revenue generating activity which has either been happened in the past or maybe it is going to happen in future. And similarly, when it comes to the outflows, we just need to see that how much of the cash we have spent in the current period, without taking this thing into account that when did this activity happen. Most probably the activity has happened in the past, for which now the cash payment is being made, or maybe the activity is like gonna be happening soon, for which the payment has been made. So in this case, while making cash flow statement, we are not applying the accruals concept, we are not following the accruals approach, the matching concept. We just need to see the cash position in which the cash inflows and outflows, cash in and cash out, these two things are gonna be netted off with each other in order to see what the net position of a company is with respect to their cash flows. And this statement of cash flows is being governed under International Accounting Standard 7. So IAS 7, International Accounting Standard 7, that deals with cash flow statements, in which, as what I've told you, that I'll be dealing with cash inflows and outflows, and basically we are going to bifurcate our cash activities in three types. Either the cash flows, which includes both inflows and outflows, they are related to our routine activities, which we call as operating activities. So either the cash is gonna be spent or the cash is gonna be generated through our operational activities, through our routine activities, through our consistent continuous activities. I mean, when we are going to purchase a material and we are going to sell it off, these are the routine trading activities that a company has to conduct. And if that is like going to generate any cash situation, this is like being held under the heading of cash being generated, cash being paid, I mean cash flows related to operating activities. Cash flows are also relevant to investing activities as well. I mean, those activities which do not happen on frequent basis, these are like one-off items, which is probably about either the acquisition of a non-current asset or the sale of a non-current asset. We know that the purchasing of non-current asset and the sale of the non-current asset, it is not a routine activity. It's all revolving around the investment activities. But if any investment activity happens, if any investment activity is undertaken by the company, whether they purchase any asset, they must have spent cash, or if they are going to sell any non-current asset, they must be generated cash. Though this does not happen frequently, but it may happen. So we need to see that how much of the cash flows are associated with investing activities, how much of the cash flows are being generated from investment activities. And the third type from which we are expecting our cash flows to be associated, these are the cash flows from financing activities. Maybe there are certain routine cases through which we are generating cash or on which we are spending cash, and these are the routine financing activities. For instance, our company has taken a bank overdraft, which happens like quite frequently. So if it has happened a bank overdraft, that is a very frequently acquired financing activity in order to finance our very short term goals, and over those overdraft figures the company must be paying cash, they must be paying interest. So there could be a chance that their cash flows are associated with certain financing activities which may be happening in a routine, as what I've told you with the bank overdrafts, or they might be linked with non-routine activities. For instance, the company has taken a long-term loan. So a loan is being taken up, or maybe the shares are issued, and the cash is being generated. But these are not those activities which are happening in a routine. These are non-routine activities, but what the purpose of these activities is, the purpose is to finance the company's operation, to finance the company's issue. So the thing is, if for the sake of any financing activity either the cash is being paid or it is like gonna be received, these are said to be cash flows associated with financing activities. So while making statement of cash flows under IAS 7, we need to deal with three types of cash flows: cash flows from operating activities, cash flow from non-routine activities, which is cash flow from investing activities, and the cash flow from financing activities.